You need to integrate the data. You can't just go, well, that's the total assets, I'm happy. You have to say, well, that's the total assets, and it breaks down this way, and it says it's got this amount of money on chain, and then I've gone over here to look on chain to see it, and it's not there. And I talk to these counterparties, and they've never heard of them. So I think the triangulation of data and then the integration of that data in some statistical net is the way to solve some of these challenges. And, challenges that remain unsolved in TradFi, it's worth saying.
You're listening to Because of Bitcoin, a podcast that shares the personal stories of how Bitcoin is having a real impact in people's lives, including mine. I'm your host, Mauricio Di Bartolomeo, the co-founder and CSO of Audited. And without further ado, let's get started with today's story. Bitcoin and digital assets are much more transparent than fiat currency. This is thanks to blockchain technology, which leaves an incorruptible trace of every transaction on the network. This on-chain visibility allows participants to cross-reference exchange activity or news headlines with on-chain data, which can have many advantages when applied to risk management strategies. Using blockchain and other publicly available data, a group of experts performed a risk analysis of the major crypto exchanges back in 2022. And the risk models highlighted a big inconsistency at the time. FTX, which was then the fastest growing exchange with nearly blind support from mainstream media and US politicians, was flagged as the riskiest exchange out of the major ones. They took heat for making that call, but 4 months later, FTX declared bankruptcy, which validated their analysis. That company was Agio Ratings, and the man behind it is Henry Stott. He holds a PhD on decision-making under uncertainty, and his professional career spans from helping the Tottenham Spurs use data to sign players to database credit analysis for financial services companies. They recently performed an analysis of Ledden's business, and they rated one of our products an A-, which is one of the top investment ratings possible. Join us as we explore how data and algorithms can revolutionize risk analysis in digital assets. Without further ado, here's my conversation with Henry Stott. Henry, welcome to the show. Thanks for joining us today.
Well, thank you very much for having me.
So you've had a very interesting career, to say the least, and we're going to get into that. But before we do, the way I typically like to start the show is asking about the person behind the professional career. What was it like for you growing up? And were money and finances a big theme in your household? As a Bitcoin show, I like to start with that because sometimes a lot of your experiences inform what you ended up becoming. So I'd love to hear from you what it was like growing up in the Stott household.
Yeah, the Stott farm. It was not particularly a money-themed house in any shape or form. I grew up on a dairy farm in a remote part of England called Cheshire. I can milk a cow. I can drive a tractor. I'm a decent shot, but my financial engineering skills were all honed after I left university and moved to New York.
That's great. And how did you decide what you wanted to study? Was there a particular event or anything that sort of led you to studying statistics? I'd love to hear more about your career. How did you decide to go into your university education? And was there anything that informed your decision?
Yeah, the great irony. So I think those that are listening that have a facility in maths, it'll resonate with them that when you're good at maths, it's really quite easy and you can be really quite good at it in a way that baffles those around you. And then you can't really do anything else. And I'm certainly incapable of doing many things. My studies in French and Latin at school were shocking, but maths I could do. And so I ended up at university doing maths. And ironically, not doing any statistics. So my parallel universe career, appropriately so, would probably be astrophysics, because at university I was very interested in all the mechanical side of maths. So that's what I specialized in. And then I got this job and I moved to New York, as I alluded to. And I arrived in New York and was working with these other maths graduates from Harvard and MIT, and it sort of started to dawn on me quite how little I knew. And they all had financial maths courses and stats courses. So I started having to do this stuff literally in the evenings to catch up because no one wanted to predict the orbit of Mercury in that office. It was it was more about bonds and things like that.
That's brilliant. And You have a PhD in decision making under uncertainty. So, from what I've heard, your undergrad was in math, then you had an interest in astrophysics, then you decide to pursue a doctorate degree on decision making under uncertainty, which seems to be an offshoot of the two things that, I mean, related, but seemingly offshoot from the previous two things that you just mentioned. So, how did you decide to go into this field? And was there anything in that office that you were discussing that led you to this type of interest?
Yeah, well, 100%. There was a big gap between my graduate and postgraduate study. How big was the gap? Can't remember. 10 years, something like that. And what happened was I was working in finance and sort of ended up with this specialization in risk management, credit risk. And we were looking at various phenomena associated with risk, such as bond premium. So this is the sort of what's the yield of this bond above a risk-free yield for that tenor, and the Z spread. And so the question was why, these Z spreads in theory should just be run, well, not in theory, but I was of the view that they should be driven by the credit risk, and yet they were not. They were driven by all kinds of things. And when I confronted people on trading floors going, why is this spread not right? They would say, wow, that's the liquidity premium. And I'd be like, what's the liquidity premium? What's that thing? And it started to dawn on me that the prices that you see in these securities and in finance in general are a function of, in effect, the psychology of the agents involved. So liquidity premium was some way of expressing a desire not to get stuck in a corner and have all the money punched out of you and lose your job. It became clear that actually the psychology of people, the cognitive science of this decision-making, if ever you were going to unravel economics or financial engineering properly, you need to understand that. So I wasn't going to read that up in the evenings. So I went back to uni to do that.
That's excellent. And I think that highlights a really good point, which is that in finance, especially when you're doing modeling and such, we want to believe, and I think a lot of that is projecting this precision of engineering and math into these people in social models, assuming in many times that people are rational beings. And very quickly, you find out just by a few conversations on the street that people aren't quite rational. And we try to retrofit a lot of these models into math when really some of the things just can't be explained, to your point, or are explained by this X factor that comes back to human psychology. And I think that's fascinating. The interesting turns in your journey don't stop there, because in my prep, I learned that you're an entrepreneur and you've done work at a plethora of spaces ranging from finance to one we're going to get into in a second. But after your PhD, you started a company called Decision Technologies. And I would like to understand, what was your goal when you started this company and what were you looking out to do?
The start of that company was more the papering of work that we had already started doing, because I was at uni, we were studying human decision-making. I had a particular specialization in risky decision-making, but in the wider field was choice and judgment type problem. And because of various contacts we had started working with Barclays and Tesco. The bank people will be familiar with Tesco. It's a big supermarket in the UK. And they had various interesting questions about why people pick that particular cheddar and other sorts of things that keep retailers awake at night. And so like, well, decision making, we could do that. So we started doing that, and it then became Decision Technology. The clue was in the name. And the North Star of the company is basically to provide the most accurate and best value forecasts of how people are going to behave in new scenarios, new environments. That's really what we set out to do. And that was 22 years ago now. We had our 21st birthday last year. So
wow.
We've done a lot of studies. We've studied a lot of cheese choice.
Well, congratulations. And the fun doesn't stop there, because I think that was the beginning of what seems like a really fun journey. I read that you were not a sports fan, but you were brought on by the Tottenham Spurs to help them sign players, which, as I was reading this, reminded me of Brad Pitt in Moneyball. I kept having this vision of you walking into the room, dumping some research reports on them and telling them why they needed to sign this player and fighting out with the manager. Can you share a little bit how you go from Tesco picking cheddar to helping Tottenham pick who they signed, and what was that like?
It does sound quite chaotic, doesn't it? The reality is there is a common core, and the common core, which even dates back to my work in credit risk and liquidity premiums, has really been that the interplay of forecasting, algorithms, machines, and experts, that's really where it's always been. I've always been like, I could build a model and I can beat those experts. I can beat these bank managers and their underwriting. I can beat Stan, the head of meat and poultry at the time, who wouldn't be told anything about how to price his chickens. But I was of the view that I could do it better, which was often quite confrontational. And then we had this column in the Times of London. And as you say, I have literally no interest and continue to have no interest in football. It is true. I come from Cheshire. My nearest team was Crewe Alexandra, which is not a bad team. But anyway, I did not grow up with football in my blood. So Tottenham approached us because of this column and they said, can you do this? So we did it. But it was another one of these, well, I can use a computer to pick players better than a traditional scout can. And I'm confident of that. So in we went and we had 10 years there with, I should say, a lot of success. So when we started at Spurs, the average league points they got in the 10 years running up to when we worked with them was about 57-ish, I think. And then during our tenure there, their average was 67. So they put on 10 league points in the 10 years we worked there. Now, when I would say to them, look, I just made you 10 league points, there'd be a lot of howling because the experts don't like it. And I don't think we're the only thing that did that. Other things were going on. They built a new sports ground, like a training facility, I mean. But there are other lines of evidence here. Various people who worked with me went on to work in other places. Ian Graham, famously, who's just written a book, went to work at Liverpool. Liverpool were absolutely awful when he arrived there. They had one of the biggest wage bills in the Premier League and one of the worst performances per £1 million spent. And by the time Ian finished working there a year or so ago, that had completely turned around. And there are lots of other examples. So there's definitely something in it. The algorithms can beat the experts pretty much all the time if you're me.
We're going to get into that in a second because I've heard one of your podcasts as you were breaking down the progression and the trajectory of this trend, which is over time, models and computers are getting better and smarter than experts and they are beating them. And if you look at the evidence, it's undeniable. And we better get comfortable with computers making decisions because it doesn't seem like it's going to slow down anytime soon. So you start Decision Technologies, you work with Tesco, you work with the bank or Barclays, then you go out with Tottenham Spurs. At one point in your career, you make a U-turn back into credit risk, or I guess back into financial risk assessment. Was there a trigger point for you to come back to finances?
Well, we never really left. Decision Technology continued to work with a lot of TradFi banks. They have, over the 22 years or so, have always been a quarter to a third of our turnover in various shapes and forms, including some risk project, for example, in the pandemic, when it's unclear how the pandemic is going to impact retail credit performance. There is a good question about how people are going to spend the checks they've been getting from the government. It never, in that sense, really went away. But it's true that as of May 22, there was a hard pivot towards credit risk by founding Agile Ratings, which is this crypto counterparty rating agency. And I think on our part, a combination of a perceived need to facilitate that market in a way that Moody's and S&P and other rating agencies had facilitated TradFi markets. And without having those kinds of risk management tools available and the consensus around some of those views, that was a huge impediment to the scaling of the crypto industry because it's an impediment to trade and by extension, exposure to each other and then by extension, the scaling of the business. You need that kind of risk management. So we saw that there was a need for that and that crypto is only going to get so far without it. And we like the idea of digital assets for various reasons, but it strikes me as a really interesting field with obviously lots of interesting and talented people working in it.
Brilliant answer. And I think two things stick out to me for that. Number one, it's a silly question, but when you were modeling the behavior of people and what they were going to spend their stimulus checks on, did you ever think they were going to spend it on Bitcoin?
No, that didn't really come up. That's true. But in reality, you're right. They sort of did it? I mean, and meme stocks more generally.
For sure. And then the second one, I'm really glad that people like you and groups as you with your expertise and talent saw the opportunity to do more credit work and understanding risk in the digital asset space, in particular, because I think it has much cleaner data and much more abundant data than the traditional finance world. It lends itself for all sorts of modeling and more accurate designs. And one of the brilliant things that you guys did when you started Agio was July in 2022, you guys went out on a limb and flagged FTX as the riskiest exchange out of the major exchanges, which was very much against the consensus view. And you did report this many months before they imploded. How was it that you arrived at this view with FTX way before anyone ever saw it?
I mean, yeah, the short answer is animal cunning, but the longer answer is that having worked building credit models since the early 90s, I've built maybe not hundreds of credit models, but tens of credit models and witnessed hundreds. My colleagues built them as well. And we did various meta-analyses over time. It's never been the case that things like the age of a company, the size of a company, the volatility of its performance and its jurisdiction and so forth, these things all count in terms of credit risk in every model that's ever been built. So sitting there in June 2022, before we really have built any models that were trained on any data, I just sat down and went, look, these things must be true. Therefore, let's say that the odds ratio, so the amount riskier that you are, if one of these things is true for you, is times 1.5 times 2, then FTX ticks all four of these boxes. It's relatively young. It's really actually quite small. And then to your point, there is all this chain data. So that's another way of deciding how big someone is, but also it's a way of looking at how volatile they are. And they didn't do very well on that either. By the time you've done all that, 2 to the power of 4 is 16. And so we didn't quite say it was 16 times riskier. But we had published this in July, and we said Coinbase is a 1.2% annual default risk, Binance is 2.9%, and FTX is 11.3%. We got a lot of pushback. And going back to experts versus algos, I mean, a lot of the pushback was revealing, and I would characterize most of the pushback as irrelevant features. So they would say things like, yeah, but they've got fantastic customer service, or they get back to you immediately, or actually the prices are better, which is not a bad argument. And I would say, well, yes, that's great. But I mean, actually, if you think about it, the prices being better kind of makes them a bit more credit risky because they're making less money. So, I mean, these things are all great for you as a trader, and I'm very happy for you, but it's not a credit risk indicator. So we have to silo that decision away from these other extraneous features.
That's really insightful. And there's some blogs on how you guys did this on your website. We'll link them up to the show notes for anyone interested that wants to take a read. We've talked about this a few times. I was listening to one of your podcasts and you explained very well this progression of how algorithms and machines have slowly started beating experts over time. And you gave a few examples of some games and how the games in which machines are beating the experts are getting even more intricate. And they started out with very basic games, very simple rules. Now it's going into things like chess and others. Can you explain how an algorithm is able to beat an expert? How do you apply this principle into the credit risk world?
1979 is what you're referring to, I think, when the world backgammon champion was beaten by BKG 9.8. It was programmed by a man called Hans Berliner. Then chess was in 97, I think. Then Go, and then recently poker. So slowly but surely, there's been this steady progression. And the literature on this goes back further. 1954 was when this guy called Paul Meehl published a book about clinical versus statistical prediction in psychiatry and laid the groundwork for this subsequent literature. The main conclusion of the literature is that experts are beaten by algorithms, and there's really 3 main causes. The first cause is that experts frequently either never get feedback on their decision or they get the feedback very much in delay. The sort of poster child example of this is spotting cancer in scans. And quite often the person that sees all these scans and tries to find the cancer trace doesn't really then get told later on whether there was or wasn't one there. Or if they do, it's months later. One thing for an expert to be good is that they get told all the time how good their judgments were. They need the training data, whereas an algorithm, by definition, has the training data. You couldn't build it unless you went to the effort of assembling whether or not there were cancers in that image. So in that sense, it's a bit unfair because the algorithms have this leg up of a nice, clean, dependent variable. The second reason is that people are very easily yanked around by extraneous features. So with FTX, people love the fact the prices were cheap. People are great at overfitting data is just a ubiquitous phenomena, which my favorite example of this is how people see faces in things. So this is why experts are not that good. They keep seeing things that aren't there. There's a great Twitter feed called Faces in Things and, examples of this over time. But people forever seeing Jesus in bits of toast. And there was that woman a few years ago who sold a pierogi on eBay for about $2,000 because it had a burn mark that looks like Jesus. Experts are kind of hampered by the fact that they will see things that just aren't there. And it's a very human thing to do because we are, if nothing, very good pattern spotting beasts. And then the third reason is we're very inconsistent. So-called sunny day effects, where you would just answer based on all kinds of other things, like what kind of mood you're in and so on. And this leads to this peculiar phenomena, which Meal in 54 first spotted, actually, which is that you could take an expert judgment, fit a model to the expert judgment, and then use that model to beat the expert on who you train the data, which is just bizarre, but true. So experts are basically inconsistent. And when you remove that inconsistency, you can beat them. So between those three phenomena, the fact that the algorithm is getting the feedback, it is not confused by multidimensional problems, and it is entirely consistent and objective. Those three things tend to give the algorithm the edge.
That's brilliant. And algorithms are always going to be great when the rule set is defined and when there's a defined goal for the game. Like if this is what you can and cannot do, life is not as clean. Things are not as black and white. There's all sorts of gray. We keep rewriting rules. That's what politicians do. They create the rule set under which we play, and that rule set is constantly changing. And we even need to have the judgment to desire to change it and then challenge some of those rules, which the machine just doesn't have to bother with that stuff. It just gets given a defined set of goalposts and says, how can I score and how do I make points? I think anywhere where there's a clean rule set and a clear outcome, the machine is going to eventually get better than the people creating the game itself.
Humans are really good at the external phase change. That's what they're good at. Where the computer is trained on a sort of domain of data. And if something's about to happen that doesn't exist in that domain, then you have a problem. So in the case of football, it could be scouting a player and they have some entirely new trick. Ronaldo may well be the poster child for this. The footwork is just categorically different to previous maneuvers. And then at that point, your model would have trouble.
Well, you could adjust it, but that's a great point. And we're going to get into some of those challenges in a later question, because that's one thing I wanted to pick your brain on. Now, going back to Bitcoin and digital assets, you specialize in rating crypto counterparties when it comes to risk. What are some of the challenges and advantages of doing this in the digital asset space?
You alluded to this earlier, actually, the fact that you've got the chain data there. And so there is some partial visibility that just is entirely missing in TradFi. And so that clearly makes it a different and interesting problem. You didn't used to spend a lot of time trying to analyze network properties in TradFi, in credit risk, in the way that you can with digital assets. But conversely, there are other challenges, and these often get cited to us by clients too, where they're saying, well, I've got unaudited accounts from 6 months ago, and what use are they, unquote. And I'm sympathetic to that point. The first point I tend to make in those meetings is you have audited accounts as well in TradFi, but how useful are those? I mean, in 2021, Archegos went under with a set of documented audited accounts, and the cumulative losses to the counterparties on the derivatives book there were $10 billion, took Credit Suisse down. So I think one needs to realize is that all data is not deterministic, that when you get a set of accounts, actually what you've been given is some kind of prior distribution in a sort of statistical sense. I think the solutions to these problems are twofold, because what you need to do is to look at things like unaudited 6 months ago accounts, all the rest of it, and treat them more as sort of Bayesian data. If I'm really uncertain about these accounts, then I'll give them a wide distribution of what actually the truth is. If I have really good audited accounts, then maybe I feel that this is perhaps to the penny correct, notwithstanding the probability of some binary event, which is massive fraud in the case of Archegos. So one needs to just be more statistical in the way one views data as evidence. And then the other point would be, consistent with that, you need to integrate the data. You can't just go, well, that's the total assets, I'm happy. You have to say, well, that's total assets, and it breaks down this way, and it says it's got this amount of money on chain, and then I've gone over here to look on chain to see it, and it's not there. And I talked to these counterparties, and they've never heard of them, so where are these loans, and et cetera, et cetera. So I think the triangulation of data and then the integration of that data in some statistical net is the way to solve some of these challenges. And, challenges that remain unsolved in TradFi, it's worth saying.
Right. I really love your point about how good are audited financial statements when we get Archegos, when we get things like Bernie Madoff, Enron, plethora of fully audited statements. Fraud is fraud. Fraud is going to show up, and bad actors are going to show up in high trust societies here and there, and they're going to wreak havoc. And you need to have systems that are able to withstand that. Same with FTX. I would argue they were audited statements from FTX USA. So audited statements and fraud are not just a catch-all for bad things won't happen. And I actually think digital asset companies have to operate at a higher level of transparency because, to your point, it's easier to triangulate data back into, are you telling us the truth? And on that point, you did some work with Ledden recently, and you rated one of our Ledden businesses as an A- credit quality. Can you speak to what exactly does that mean? And the follow-on is, how did you measure that risk?
So, I mean, the use of the term A- obviously an allusion to S&P, who have these ratings and have a history of how often those things default. But at that point, it gets quite ambiguous, actually, because if you look at what S&P and Moody's are actually categorizing, it's quite unspecified. So you don't actually really know over what time horizon these things work beyond, they think they tend to allude to short and long term, or whatever the exact phrase they use is. It's also, between the two institutions, there tends to be this implication that Standard & Poor's is focused on will a counterparty default, whereas Moody's is more focused on what's your expected losses from this institution. And those two things are not identical, because in formal terms, over a fixed period of time, so let's say over the next 12 months, what's my probability of a default event, where we can talk about what the actual definition might be. But, someone's asked me for money and I've said I haven't got it in some way.
Right.
What's the probability of that happening in the next 12 months? And then if that happens, how much of my exposure to that organization am I ever going to see again, the so-called severity or loss given default? And then when you multiply those together, you get the expected loss, which is more the thing Moody's is doing. But of course, all this is quite blurry if you're them. So what we have done is put numbers on the things that you need. We have gone and said, right, the default probability of this counterparty is 0.43% in a 12-month period. And if that counterparty goes under because of the collateralization and the other structure of the exposure for this particular kind of counterparty, or this kind of lender, you would expect the severity to be about 10%. You would lose about 10% of your money. The normal number is higher, 40%, 50%. So you're a 0.43% chance of running into a 10% loss. So your expected loss is 4 basis points. And that is approximately equivalent to an A-.
That's brilliant. And for people that are more interested in learning about this, we have a blog out that we will also link to the show notes. And I think that this is the beginning of hopefully a great trend that we continue to see in the space. If people had followed your work before FTX, they would have served themselves quite well to at least hedge or diversify the risk or understand the risk. Many people just didn't understand it. And one of the biggest points of frustration for me back in the 2021 days was when you had these websites that were ranking lenders by the yield they paid on a particular asset, and they would stack them up as they were apples over different apples. And I would scream to the world, these are not the same. But everybody just said, oh, you're paying interest, they're paying interest, they're paying 8, you're paying 7. I'm going to go to 8. And I said, my 7 is very different from their 8. I can tell you where I'm getting mine. I don't know where they're getting theirs. Have you asked them? And people would run like bugs to the light. And it was infuriating not to be able to complement the return with the risk, because what you want to be looking at as an investor is your risk-adjusted return. Returns without risk, you're setting yourself up for pain. And I hope that we continue to see more of this in the space. And that's why we're so happy to be working with you guys to pioneer this idea of rating companies. We volunteer for this. We want this to go out because we're so proud of our risk management policies. And it's been great getting to work with you guys. And we look forward to keep doing more with you and you guys doing more with the space, because I think it will make us all a lot better and protect a lot of people. One of the things I wanted to ask you about is this idea of models and incentives to try to game the models. So at the end of the Times article that was talking about the data-centric approach that you guys did with the football teams, et cetera, there was a section at the end that stuck with me because it said that once the player knew what metrics were being tracked, they started to devise ways to game the system or game the models. Do you think that a similar risk could exist in other database approaches, i.e. what you're doing for risk and other things in the digital asset space?
My answer to that would sort of be no-ish. In the case of football, that particular example, for reasons that you would have to ask them, but are mysterious to me, the amount of distance that people player ran in a game became a kind of interesting number to some people. I don't know, it's easy to measure, it's easy to explain. But if you're me, it is completely meaningless number. It predicts literally nothing. So the fact that you're able to game some statistic that in the end actually has no outcome is at that point a curiosity. I think if you had a model that really worked and that the thing that you were feeding into it was actually predictive of something, and then someone was gaming it, well, then at that point, are they gaming it or are they actually making themselves better? So, the example might be in a properly predictive model, of a default risk, the amount of leverage a company is carrying is predictive of that default risk. The equivalent of that goalkeeper running up and down to get a distance up, the equivalent here would be someone deciding to reduce their leverage to get that metric better. But at that point, because it actually mattered, the risk would actually be lower or higher, depending on which direction they were going in. So the gameability of these things is partly down to just their weakness as models. That said, as we were talking about earlier with Archegos, there is the possibility also for out-and-out fraud, or even on the nearer side of that, embellishment. You hear about people dressing their companies for sale, in effect, gently misrepresenting the profitability of an organization by not investing in it with a longer term horizon, I suppose. So in that sense, some of these things are gameable, but it's a test of a decent system that the better it is, the harder it is to game.
I love your answer. I think it has more to say about the model itself than the people gaming the model. Like, it would be really hard if you're triangulating balances among different lenders and counterparties and checking on-chain custody balances. That's very difficult to misrepresent. You can't misrepresent on-chain data. And many times when you triangulate it, one bad actor might be able to misrepresent something to you, but when you're trying to cross-reference that with a different source, then you're making it much harder to go out of bounds and do something bad. So I think the way you think about the model is key to the accuracy of it. And I can think from the work that you've done previously and what you've done already in this industry, it shows that you guys know what you're doing. I'm really excited to see where this goes for you as well. And one of the questions I have here as we're getting towards the end is, what is next for you and Agio Ratings? Any exciting things coming up?
In general, our strategy is to sharpen the toolbox. We've developed various risk measurement methodologies that are appropriate to the data environment that's unique to digital assets. And also, we haven't really discussed, but the clock speed of digital assets. This is a much higher cadence sector. Quarterly ratings and reviews is not going to cut it. So we have to develop those methods, which we have done, but then there's always opportunity to find ways to incorporate other data sources, basically improve your predictiveness, improve the mechanization, and indeed accumulate proprietary insight as we go along. We've had a few years of doing that. As we do more of the kinds of research that we did around the Ledden entity, we will just learn a lot about how to model these different things and what the norms are, etc. So more of the same, I think, is sort of the is what's next for Agio.
Well, we look forward to continue contributing whatever we can to groups like yourself so that we can permeate a lot of this knowledge and risk management through the industry. I'd like to think that when it comes to lending, your model is getting trained on the best in class.
Yes.
So you'll be able to cross-reference that, and people will be able to see a little bit more and get more insights by reading your report and the work you did with us. So that was really the intent, is to get people to understand how we do things and why we're different. There's a lot of talk that is not necessarily pertaining to risk management. So people get carried away with asset support and listing the newest thing and adding leverage for that. And that really is completely unrelated to how likely are you to be able to withdraw the assets, as we've now learned. Our focus has always been on the return of your assets, and then return on your assets comes second. But that's not how many firms, unfortunately, have operated in this space. So we're trying to change that. Henry, this has been great. For people that want to read more about your work, learn more about what you do yourself and Agio, where can you point them to?
So LinkedIn, for better or worse, Henry Stott. If you put Henry Stott into LinkedIn, it's a reasonably rare name. I am not the electrical contractor who lives in Camarillo, California. I'm the London branch of the family. So if you look that up, then from there's a link to Agio and Decision Technology. And it's not an onerous task to follow me. I post about, once every month or so, usually some graph that I find interesting. Next graph is going to be about the US presidential election. Shy voters. We're just doing the field work now.
Our first few episodes of the season were with David Bailey, and the second one was Anthony Scaramucci, because we wanted to understand from the two red and blue camps, what do they expect or what do they see as the potential challenges and opportunities on each one. But this is going to be really interesting. I'm really curious to see, because that's a lot of decision under uncertainty. I think applying that to an election context would be super interesting. So I really look forward to seeing that graph come out. Henry, thank you so much for joining us. I look forward to continuing to work with you guys and hopefully bringing you on again in some time when you guys have done some more work with Ledden to talk about it.
Fantastic. Well, thanks very much.
Thank you so much. After this conversation, I've been reflecting on my own biases. The point Henry made about how machines trained on the same data can consistently outperform human experts with the same data set due to their speed and efficiency really stuck with me. Emotions often cloud our judgment, which highlights the need for robust systems and protocols in businesses. As data models and processing power get better, machines are increasingly surpassing human decision-making in rules-based systems. At Ledden, we recognize the value of data-driven approaches in our risk management. We were the first centralized lender to receive the rating from Agio, and our top-notch data and AI teams help us make real-time data-based decisions. While risk ratings may not grab headlines, they can protect market participants from pitfalls. Those who followed Agio's insights in July 2022 could have saved significant money. We're proud of our strong rating from Agio, and we look forward to the evolution of risk rating solutions. The future is digital, and we're ready for it. Stay tuned for another great episode. If you enjoyed this Because of Bitcoin episode, I would be very grateful for the 5 seconds it would take you to drop us a review and give us a rating on your favorite podcasting platform. This will really help us reach even more listeners. And if you'd like to learn more about Bitcoin, be sure to check out our newsletter by subscribing at ledn.io. That's ledn.io. Again, this was Mauricio Di Bartolomeo. Stay tuned for our next episode. And until then, muchas gracias y los quiero mucho. Chao, chao.